You've put out a note today which actually looks at the recovery in gross domestic capital formation this year, as well as the external environment improving. How about domestic demand? Are we starting to see a recovery in domestic demand? We're going to get those retail numbers out, which are going to...
Yes, that's right. And I think particularly the consumer is looking quite good. We had very good consumption data last year. Consumer grew by about 4% last year, but that was largely World Cup related. I think this year you're going to see a similar reading, but that's more fundamental underlying growth that's coming through. I believe as job creation, for example, kicks in towards the end of the year, we should see a much more broader based consumption expenditure coming through in South Africa this year.
And you would expect job creation to start kicking in at the end of this year?
Absolutely. I think the second half of this year we'll start seeing jobs come through. We're looking for as much as 250,000 jobs being created this year.
In which sectors would you expect those jobs to be created? Because we had Gwedi Mantashe, the ANC Secretary General, yesterday talking about 350,000 jobs being created in the manufacturing sector over the next number of years. But we have seen from the PMI numbers yesterday, employment in the manufacturing sector continuing to contract.
Yeah, no, that's correct. I think you will see some jobs coming out of manufacturing production. You've seen significant declines in that sector, and the last 2 or so readings have shown the sector is beginning to pick up quite nicely. The PMI data is about 50, which shows there is some expansion taking place. Obviously, it's not as high as the 55% type levels that one would be looking for. But we believe over the course of the year, 2 things happen. Obviously, the interest rate cuts you saw last year will take some time to come through the numbers. And then we also believe the rand probably weakens in the second half of this year. We guess we are very close to the bottom in dollar rand here. So the combination of those 2 should lead to some recovery in manufacturing production going forward.
In fact, in your note today, you said the rand weakening to 7.50 to the dollar by the end of this year, moving to 8 rand by the end of 2012. So not dramatic weakness coming through from the currency. It looks quite stable.
Yes, I think it's a different environment now. Gone are the days where South African rand was a one-way play. It's more evenly balanced now. And I think, remember also, South Africa is doing relatively well compared to your developed world. I mean, the growth in this country is not that bad. So from a fundamental perspective, the excessive volatility that we used to see in the past, I think there's a lot less reason for us to see that going forward.
We had Fitch yesterday upgrading its outlook for South Africa from negative to stable. Some economists saying it was a long time coming. Do you think that reflects how we've come out of the recession and how we're heading into 2011?
Absolutely. I think South Africa has done very well. I mean, in the recession, if you think of the growth rate of minus 1.8 compared to minus 4, minus 5, even minus 6 in some of our competitors, we did relatively well. Then we've come out now 2.7, 2.8% for 2010. You know, it's not a bad growth rate at all. And I think what also drove that fiscal, that upgrade was really the fiscal numbers. I mean, South Africa's fiscal accounts are looking really very good, and I think the authorities deserve a lot of credit for that.
What sort of growth would you expect then for 2010?
2010, with hindsight, you've already got 3 quarters.
Sorry,
in the back,
2011.
so 2.7. I mean, you're behind. No problem. 2011, we're looking for 3.5%, and we think you have a similar reading as well in 2012. So look, it's going to be lower than your sort of CEMEA average of about 3.8, 3.9, which we forecast. It's slightly below the average of our peers, but still, you know, 3.5% growth, 300% GDP growth rate in South Africa is not bad, given the kind of environment in which we are.
We've had the government, though, talking of growth rates of 5 to 6%, which they say is what we need to cut employment down to 15% over the next 10 years. Is that achievable? How do we actually get to those growth rates?
Look, we have some real structural constraints in this country that will take a long time to unwind, particularly the skills level, the level of education. These are real constraints that will take more than a generation to unwind. Now, once you break those hurdles, then we can start talking about sustainable 6% GDP growth. At the level, at the moment, I think we'll struggle to get those kind of growth rates.
CPI, we're getting a reading out tomorrow. What's your expectation on that side? Where would you see inflation going this year? Because it looks like it's becoming a little more bearish than it was a month ago.
Yes, I mean, we've been saying for some time now that food inflation is likely to surprise, to the upside. We still maintain that view. We've got inflation about 4.5% this year, as much as 5.5% next year. The central bank's numbers are 4.3 this year and about 4.8. So there's quite a bit of a bet between our numbers and the SARB's numbers, and it's largely driven by food price. And obviously, what we think will be a weaker currency in the second half of the year. With the upcoming CPI data for this week, we're looking for a reading of 3.5%, and another consensus I think is around 3.6, so we're slightly below that. 3 key sources of risk to that reading. I think the most important one is food prices. Your PPI suggests that food prices have already bottomed and could be headed higher. We may be surprised with the upside, with the possible upside surprise in food prices tomorrow. Apart from food prices, you also have rental inflation. Now, the last rental inflation survey, the numbers that came out appear to be relatively high. You would have thought that after the World Cup, immediately after the World Cup, rental growth would have slowed down a bit, and it hasn't. So we think that this particular reading, we could well see some downside surprise in the rental reading. That's why we have a 3.5 against what I think is the average of about 3.6 on the street.
Do you think we could have the Reserve Bank adjusting its inflation outlook when it gives its statement on Thursday?
I think it's unlikely that they'll move on rates again. Like the concerns they had towards the end of last year about GDP growth, both in South Africa and the rest of the world, I think those concerns are fading. You've had some really, really strong manufacturing data coming out locally. The US seems to be turning the bend quite nicely. In Europe, there's a lot better demarcation between the peripheral countries and core European countries. We seem to be doing quite well. I think when the MPC meets this week, I mean, the chances that they will be as worried as they were the last time, I think the chances are quite slim. And then you've also had already beginning to see some upside surprises in inflation. They made it quite clear in the last MPC statement they weren't expecting oil prices to rise. Oil was just above 80 at the time. We're now talking, close to 100. So putting all these together, I actually wouldn't be surprised that the central bank is probably forced to revise its CPI forecast already, for 2011 and most likely for 2012.
When would you expect interest rates to start rising in that case?
We have the first rate hike in November this year, and I know it's earlier than consensus, but once again, it's because we think that the central bank will be surprised by the food prices. That probably kicks through somewhere in the middle of the year towards the third quarter. You'll probably start seeing big surprises in food prices. Typically, the lag between international and local is anything between 6 and 12 months. You've already seen international prices, food prices rising significantly. We haven't seen it reflect in South Africa yet for two reasons, largely because of the good maize harvest that we've had locally, but also because of the currency. And now once the currency starts to unwind, and you probably will find some higher food prices coming through as well. So, putting all these together, it is quite clear to us that the risk is to the upside on the food price front.
And going from that rate hike that you're expecting in November, how many hikes would you expect in this cycle before we can stabilize again?
Sure, we've got about 150 basis points of rate hikes. Now remember that what we're talking about here is not really tighter monetary policy, because your growth rates are not shooting the lights and you're not going well above trend. At 3.5%, you're pretty much in line with the trend GDP growth rate. So you shouldn't be tightening policy. What we're talking about here is policy normalization. You got to take interest rate back to what you think is an equilibrium level, given the steady growth rate. And that steady growth path we think will be consistent with another 150 basis points of policy rate hikes from here.
So we're not looking at any more interest rate shocks where we see the prime rate shooting up to 15-20%?
I think those days are gone, unless something goes radically wrong, on the currency front, on the food price front. I think it's unlikely.
I hope those days are gone. Michael, thanks very much for coming in today.
Thanks.